Another day, another story. Investopedia says that an inverted treasury yield curve is one of the most reliable indicators of a recession. Yield curve inversion? What is it? Well, yield curve inverts when long-term rates drop below short-term rates. This looks like problem of plenty. Let's go back to Investopedia to simplify this. It says that market participants focus on the yield spread between the 10-year and 2-year bonds. So, let's stick to this and perform back testing on all crashes from 2000 onwards. I have selected the S&P 500 index to represent the stock market, and 10-year bond yield with 2-year bond yield to identify the yield curve inversion. At the top pane is the S&P 500 chart, and below it are the 10 and 2-year US Treasury bond yields shown in red and blue respectively. At the middle of the chart, we see the year 2000 bull market top, followed by the dot-com bubble bust. It was the crash of the internet companies. Let's see if the 10-year and 2-year bond yield curve inversion preceded the dot-com crash. Seeing is believing. In February of 2000, the 2-year yield crossed above the 10-year yield. Now, when that happens, it is called yield curve inversion. Let's now see how the market reacted to this yield curve inversion. The stock market made a top in August of 2000. 6 months ahead of the crash, the bond market had predicted the event. Let's now examine the 2007 stock market crash. In February of 2006, the 2-year yield crossed above the 10-year yield. And, in October of 2007, the stock market topped out. That is, the stock market crashed 20 months after the bond market yield curve inversion. Well, that's how strong the bull market was back then. Let's now check the COVID crash of 2020. In February of 2020, the market crashed, suddenly and violently. However, the 2-year Treasury yield didn't cross above the 10-year yield. Though, we can see that the yields were getting close to each other, and about to merge much before the COVID crash. Why didn't the yield curve invert? Any guesses? Easy. This crash was not caused by a direct financial or economical reason. It was primarily due to the fear and uncertainty brought about by the COVID situation. Finally, let's check the 2022 market correction. Observe that the stock market started correcting from December of 2021. Strangely, the 2-year yield didn't cross above the 10-year yield until July 2022, which is a lag of 7 months. However, near the top, the yields started converging. The reason for delay in inversion is this. Look at the 2-year yield for most part of 2020 and 2021. It was unusually closer to zero, right? Yes, that's because, post-COVID, the US central bank kept interest rates close to zero to boost the economy. But, every action has a reaction. In this case, the loose monetary policy resulted in hyperinflation. To tame inflation, the central bank started raising interest rate. This finally allowed the yield curve to invert in July 2022. Better late than never. So, if the central bank hadn't tampered with the rates, then we could have got the signal as expected. However, as of November 2023, we see that the yield curve is still inverted. In other words, the 2-year yield is above the 10-year yield. So, as long as this state continues, we should expect the market correction to continue. And, if there is economic recession in 2024, then we could see a violent crash as well. Now, stop blabbering your doomsday prediction. In the next video, let's see the prediction capability of the 2-year Treasury bond yield combined with the 3-month yield. Thanks for watching. For more videos, like, share, and subscribe to my channel. Also visit my website www.VLearnHub.com for any learning or promotional requirements. Thanks for watching.